My name is Tim Farrelly. I'm a member of the First Financial Investment Committee. Obviously, there's been a lot of market volatility recently, and so it's a good time for an update. What I'm going to take you through today is firstly the outlook for inflation and interest rates, the outlook for growth assets, and the outlook for defensive assets. And we're going to look at it both on a short-term and a longer-term perspective. And then finally, what are we likely to be doing about that in the longer term? We'll talk about inflation and interest rates to start off with. Inflation is the underlying cause of most of the difficulty we've seen, and in particular, it's the response of central banks to that inflation which is causing so much uncertainty. Now, the cause of inflation itself, it started out with the bottlenecks that emerged at the back end of COVID. It was difficult getting products into markets, shortage of products, prices go up. But then it's become more pronounced with particularly the war in the Ukraine, which has created shortages of both energy prices are up, and now food, because Ukraine is such a big producer of food prices also going up. And finally, probably most worrying of all, we're seeing wage pressures coming through, particularly in the United States, but we're also seeing some element of that here in Australia. So it's shaping up as the sort of the perfect inflationary storm. And why are markets so worried about it? Because they're worried about what the central banks will do. So the Reserve Bank in Australia, the US Federal Reserve, typically vary interest rates up and down to meet their mandates, which are keep inflation under control, in Australia somewhere between 2 and 3%, or in the United States around about 2%. But they also want to keep fairly full unemployment in the longer term. So it's inflation first, employment in the longer term. So right now, as inflation picks up, central banks are doing what they say they were going to do, which is lift interest rates to slow the economy and take away inflationary pressures. Now, there was some concern a few months ago about whether the central banks actually had the nerve to do this. Would they actually put economies into recession? Well, all those doubts are now gone. Everything that central banks are saying, everything that central banks are doing suggests they will do whatever it takes to firstly control inflation and then to let economies recover after that. They are willing to put us into recession if they have to. Their preference is not to do so. Their preference is just to slow economies enough in order to control inflation. But if that's not enough without going to recession, they will do that. And that's one of the underlying causes of the fear we're seeing in the equity market in particular, but also in bond markets, and we'll touch on that one later on. Now, one of the questions that arise out of that is, what are the chances that they're going to put us into recession, and what will it take to put us in recession? Well, in the case of Australia, we've got some pretty good guides, and we can look at what has happened in the past, in cash rates in particular, and we see in cash rates in the past that they have risen sharply, certainly back in the late 80s, where interest rates are around 18%, which give rise to some people asking the question quite reasonably, are cash rates going to 5, 10 or even higher in the future? We think it's really unlikely. And so here we see that what the past rises have been. You say, well, why is it unlikely that we won't see, why is it not likely that we'll see an 8% cash rate increase? And the reason is the huge increase in household debt. That has gone up almost fivefold when looked at as the amount of debt per household as a percentage of household income. What that means is a 1% increase in cash rates in Australia will bring about 4 to 5%, or 4 to 5 times, the amount of pain that it would have back in the late 80s. And so we can adjust these increases to say, well, if you adjust them for the size of the increase in debt, what do we see? And we typically see somewhere between 1 to 3% increase in cash rates should be more than enough to significantly slow the Australian economy, or indeed put it into recession. And our expectation is that we go much beyond 3. We are into a recession territory here. And the RBA in Australia is completely aware of that. So we feel that the RBA has got a reasonable chance of finessing it. But if they have to go further than that it takes to just get a nice gentle slowdown, they will do it. And so there's a slight chance cash rates go above 3, but we think not much. So that says One, in the long term, the chances of central banks bringing inflation under control, I think, are very high. They've got all the tools they need with so much household debt. And the uncertainty is really what the next 2 or 3 years look like. Will they have to go really hard and create a recession, or can a gentle tap on the brakes be enough to do it? We don't know the answer to that one, and we think it's the chances of going one way or the other are about 50-50, and which makes for a lot of uncertainty in the short term, but much less uncertainty in the long term. So, as is so often the case, with inflation and interest rates, the short term is really hard to see, but the longer term is much more straightforward. I think we'll see within 4 or 5 years, and probably earlier, inflation really brought under control, cash rates lower than they, or certainly lower than they're implied by the markets today. So let's look at what does this mean for the outlook for growth assets and for defensive assets. Well, for growth assets in the short term, next 1 to 3 years, the really critical question is, are we in for a hard or soft landing? The one I've just spoken about. And frankly, we don't have a really good read on that. And as a result, you see prices falling. And if we have a hard landing, I suspect equity prices can fall further. If we don't, they start to recover from here. And so it's just a really difficult position in the short term. But what we do know is if we do go into recession, that recession won't last forever. We do know that inflation is very likely to be brought back under control. And so we look at current prices, obviously lower than they were even 6 months ago, and we say we can expect to get better returns going ahead. So this is what our returns look like right now, higher than they have been certainly at December last year, and it's because prices are lower. The less we pay, the better returns we receive. And this shows up again in our tipping point charts, where markets are starting to look more like being in fair value or on the borderline of being cheap. So once again, for growth assets, the short term is really difficult, but the long term, the outlook looks pretty bright. And as long as we maintain that long-term focus, the returns should be pretty solid. Outlook for defensive assets, it's much the same again. Many defensive assets, particularly bonds, have really been crunched. In fact, it's one of the biggest bond market falls for over 50 years. Now, many ask, well, how is it that government bonds, which have got a guarantee of repayment of capital, can fall in value? Well, probably the easiest explanation that we can come up with is think about a term deposit. Let's say you've entered into a 5-year term deposit at a rate of 1%, and the going rate is now more like 3%. You think, well, I would rather have the 3%, so I'll go along to my bank and say, I want to cash in my term deposit and reinvest it at one of the 3% ones because my 1% is not much good. Well, guess what's going to happen? The bank will say, look, we're happy to give you your money back, but there's going to be a break penalty. How much is the break penalty? Well, if your current rate is 2% under market and there's 5 years left to run, it's going to be about a 10% break penalty. Now, you don't see that in your statements, but if you went along and said, I want to cash that in, that's what would happen. Bonds are actually no different. And what we see here is a bond paying 2.25% with it's got 6 years left to run. Now, the current rate is about 3.75%, about 1.5% higher. So if you were to buy this bond at 100 cents in the dollar, you're missing out on 1.5% for 6 years, about 9%. So guess what? If you want to buy one of these bonds, or indeed if you want to sell one of these bonds, if you're one of the holders of it, you're not going to get paid 100 cents in the dollar. It's like if you go along to the bank and want to break a TD, and lo and behold, this thing is trading at about 91 cents in the dollar. This also shows you how these bonds can actually rise in value as well as fall in value. They were trading above $1.10 earlier on in the year, and since then they have fallen in value about 16 or 17%, which is basically what the bond market's done. It's quite a big fall, but unlike equities, when you're an equity market fall, there's no guarantee it will rise back. Here, with this particular bond, it will go back to 100 cents in the dollar in 6 years' time, and that's government guaranteed. So bond market falls tend to be short-term in nature, and if you were to buy into that bond today, you get not only the 2.25% it pays as its coupon interest rate, but also you get that capital gain down the track, which brings you up to a market rate of sort of 3.75 or 4% return. Bottom line is, right now, as a result of these falls, again, Defensive assets are probably looking more attractive than they have any time in the last 7 or 8 years. Difficult where you've been holding some of those that have fallen, but the forward-looking outlook is much more attractive. In the short term, we still don't know how high interest rates are going to go in the very short term, so there may be further pain in this amongst bonds and fixed interest type investments, but in the long term, we know it's going to bounce back. So everywhere we look right now, the short-term outlook remains challenged, but the longer-term outlook is brighter than before. So we're now looking very closely at portfolios on both the growth side and the defensive side at where the opportunities are rising, and that's an area where you can expect to see some changes coming through in the coming months. Thank you.